A business generates a chaotic swirl of physical activity and cash movements every day. Relying on raw cash flow to measure performance often paints a distorted picture of a company's actual health. The income statement solves this by imposing a rigid grid of accrual accounting over that chaos, engineered specifically to separate repeatable operations from isolated anomalies. To achieve this, the statement relies on a strict mathematical architecture. Total income equals revenues plus gains minus expenses and losses. Notice the core of this equation. Revenues and expenses represent the actual inflows and outflows from delivering goods or providing services. They are the engine of the entity, capturing activities that qualify as ongoing, central operations. Gains and losses are pushed to the periphery. These track equity changes from activities outside the core business, like selling factory equipment. They are real economic events, but incidental to the main objective. Analysts rely on the multiple-step income statement format to physically sort these operational variables from the incidental ones. By splitting the numbers into distinct sections, the statement forces companies to reveal exactly how much profit came from their actual business model. The structure of the statement prevents management from hiding a weak year of core sales behind a massive one-time gain from a real estate sale. It allows us to determine the true quality of earnings, rather than accepting a raw bottom-line dollar amount at face value. The largest deduction from top-line revenue is almost always the cost of goods sold. Following the matching principle, this specific expense is entirely quarantined until the exact moment a customer takes ownership of the product. For a simple retailer, calculating this is straightforward. You track the inventory on the shelves. But a manufacturing firm builds its own inventory, which requires a multi-layered cost-tracking system to capture the physical flow of the factory floor. Take a look at this accounting record from Amy's Manufacturing. To calculate the final cost of goods sold, we first need a subschedule to track 3 distinct stages of inventory: raw materials, work in process, and finished goods. We start step 1 by calculating the raw materials actually consumed. The factory begins with $65,000 in materials, adds $240,000 in new purchases, and then subtracts the $58,000 left over at year-end. That leaves $247,000 of raw materials pushed into active production. In step 2, we account for the effort required to transform those materials. That $247,000 merges with $300,000 of direct labor and $105,000 of factory overhead, creating a total manufacturing cost of $652,000. Because work on the factory floor is continuous, we adjust for the work-in-process inventory. We add the beginning WIP balance and strip out the ending WIP balance to isolate the exact cost of the goods entirely completed during the current year. This outputs our cost of goods manufactured, $632,000. Finally, those completed goods move into the finished goods inventory. By adding the initial stock and subtracting what remains unsold at year-end, we arrive at the final recognized cost of goods sold, $636,000. This is the formal 4-step mathematical proof analysts use to verify those numbers. It maps the physical reality of the factory directly into the standardized reporting format. For a manufacturer, cost of goods sold represents the final, matched culmination of an entire physical production cycle, remaining quarantined in inventory until the exact moment a customer takes ownership. Subtracting that cost of goods sold from total sales revenue gives us gross profit. This represents the raw margin the company earns purely from producing its product, before any corporate overhead is considered. Below gross profit, we deduct operating expenses, starting with general and administrative costs. These are enterprise-wide expenses incurred for the benefit of the entire organization, things like executive salaries, legal fees, and accounting services. Next are selling expenses. Unlike corporate overhead, these are directly tied to marketing and distribution. This includes sales commissions, advertising campaigns, and the freight costs required to ship the product to the customer. Non-operating items like interest expense follow. Interest is recognized strictly based on the passage of time using the effective interest method, reflecting the cost of financing rather than a daily operational activity. By systematically stripping away the pre-action costs, the administrative overhead, and the financing obligations, this middle section of the statement distills the financials down to the pure operating efficiency of the core business engine. Sometimes a company decides to completely abandon a major segment of its business. If the financial results of that liquidated division remain mixed in with the main statement, external analysts will base their future projections on revenue streams that no longer exist. The multi-step format solves this by establishing a strict regulatory boundary. Look at this statement. The line labeled Income from Continuing Operations acts as a hard floor for the core business. Any data regarding a discarded segment is pushed entirely below that line into a quarantine section known as Discontinued Operations. Because this section sits below the main corporate tax line, it requires a process called intra-period tax allocation. Notice how the $4,000 of income taxes related to the dead unit are nested entirely inside its own block. Discontinued operations must always be presented net of their own tax effects. This isolated section captures two distinct elements: the actual operating gain or loss the dead unit generated during the year before it was sold, and the final gain or loss triggered by the actual disposal of the asset. By quarantining these numbers net of tax, the multiple-step format ensures that investors are analyzing the ongoing engine of the company, completely free from the financial ghosts of units that have already been liquidated. We are conditioned to view net income as the absolute bottom line of corporate performance, but net income contains a major structural limitation. It does not actually capture all the changes in a company's equity during the year. Certain market fluctuations are too volatile to include in net income, as they would heavily distort the core operating metrics. To capture these, accountants use a secondary holding zone that sits directly below the income statement, called Other Comprehensive Income, or OCI. OCI catches four specific items: the effective portion of cash flow hedges, unrealized gains and losses on available-for-sale debt securities, foreign currency translation adjustments, and specific amounts tied to defined benefit pension plans. By adding standard net income to OCI, we arrive at comprehensive income. This figure bridges the gap, representing the true total change in the net assets of the business, excluding only direct investments by or distributions to the owners. Even these comprehensive totals are bound by the mechanics of accrual accounting. Because the system records revenue at the moment a service is delivered or a product is shipped, often on credit, the statement reflects earned income regardless of whether the cash has actually entered the company's accounts. The income statement is an engineered map of operating performance, not a flawless ledger of cash. Understanding how it categorizes costs, quarantines dead positions, and defers volatile market swings is the only way to accurately read the business terrain hidden behind the bottom line.